Imagine you're paying $1,200 a year for car insurance and you've never even filed a claim. No accidents, no tickets, nothing. You think you're paying for your own protection, right? Wrong. You're actually paying for the guy who rear-ended a Tesla at 60 miles per hour, the woman who claimed a phantom injury after a fender bender, and the insurance company's CEO who just bought a third vacation home. In 2026, the average auto insurance premium in the U.S. hit $2,114 annually, up 26% from 2022. Yet, only 12% of that premium goes to covering your own car repairs. The rest, it's a hidden tax on your driving record. Today, I'm going to show you exactly where your money goes, why you're subsidizing bad drivers and fraudsters, and how to stop being the insurance industry's piggy bank. Stick around until the end for one simple move that could save you $500 this year. This isn't speculation. According to the Insurance Information Institute, the average auto insurance premium in the U.S. increased by 26% between 2022 and 2025, reaching a record high of $2,004 in 2026. Meanwhile, the National Insurance Crime Bureau reports that insurance fraud costs the industry over $40 billion annually, adding $300 to $400 to every honest policyholder's premium. Even more shocking, a 2025 study by J.D. Power found that 67% of drivers don't know what their policy actually covers, meaning most people are overpaying for coverage they don't need. So why are you paying more while getting less? Because the system is designed to profit off your ignorance. Think of your car insurance premium like a neighborhood pizza party. You chip in $50 expecting to get your fair share of pepperoni and cheese. But instead, the host uses your money to buy extra-large pizzas for the neighbors who never contribute, pays for a gourmet chef who eats half the pizza himself, and then charges you for the paper plates. You're left with a single, cold slice while everyone else feasts. That's exactly how auto insurance works. You pay for the bad drivers, the fraudsters, and the executives, while your own coverage gets thinner every year. 1. The 12% rule. Your premium is mostly a lie. Most people assume their premium is a direct trade for their own protection. In reality, only about 12% of your premium goes toward paying claims for your own vehicle repairs. The rest is split between covering other drivers' claims, 52%, administrative costs, 20%, fraud, 10%, and profit, 6%. So, when you pay $2,000 a year, only $240 is actually set aside for your car. The other $760 is funding everyone else's mistakes. 2. The uninsured driver tax. In 2026, 1 in 8 drivers on U.S. roads is uninsured, according to the Insurance Research Council. When an uninsured driver hits you, your own uninsured motorist coverage kicks in. But guess who pays for that? You do, through higher premiums. States with higher uninsured driver rates, like Mississippi and Michigan, see premiums 40% higher than the national average. You are literally paying for people who break the law by not carrying insurance. 3. Fraud. The $40 billion silent thief. Insurance fraud isn't just a movie plot. It's a $40 billion annual industry. Staged accidents, fake injury claims, and exaggerated repair costs are rampant. The Coalition Against Insurance Fraud estimates that fraud adds $300 to $400 to every honest policyholder's premium. In cities like Miami and New York, where fraud rings are most active, premiums can be 50% higher than in low-fraud areas. You are subsidizing criminals who treat your insurance like an ATM. 4. The coverage you don't need. Many drivers carry comprehensive and collision coverage on cars worth less than $5,000. A 2025 study by the Zebra found that 40% of drivers overpay for coverage by $400 per year simply because they haven't dropped old car insurance. If your car's value is less than 10 times your annual premium, you're throwing money away. For example, insuring a 2015 Honda Civic worth $6,000 with full coverage at $2,000 a year means you're paying 33% of the car's value annually, a terrible financial decision. 5. The loyalty penalty. Insurance companies love loyal customers because they know you won't shop around. A 2026 report from Consumer Reports found that drivers who stay with the same insurer for 5 years pay an average of $300 more per year than new customers. Meanwhile, switching insurers can save you up to 30% on your premium. The industry calls this the loyalty penalty, and it's a hidden tax on complacency. By not comparing rates every year, you're essentially donating money to your insurance company. Here's your one concrete step. Pull up a comparison site like the Zebra or Policy Genius right now and get quotes from at least 3 insurers. If you haven't shopped around in the last 12 months, you're almost certainly overpaying. Set a calendar reminder to do this every year on your birthday. And if you want to dive deeper into how to build real wealth instead of just saving on insurance, check out my video on the 5 hidden costs keeping you from financial freedom. Don't forget to hit subscribe so you don't miss the next breakdown. Your wallet will thank you.